No one wants to be audited by the IRS. We all know that the real point of an audit is for the IRS to collect more taxes. Being selected for an audit doesn't always mean that you've done something wrong, but there are some issues that might cause the IRS to take a closer look at your tax return. As a former IRS auditor, I'm going to share the 7 top audit risk red flags and triggers that cause individual taxpayers the most trouble. I have a separate video about audit red flags for a small business, so I won't cover that here. First, let me tell you how the audit process works. You will be contacted through the mail. The IRS used to contact taxpayers by telephone, but there are too many scammers out there now impersonating the IRS over the phone. So if you receive a letter, please respond as soon as you can. You don't want the IRS to make automatic adjustments to your tax return because you didn't respond. Speaking of mail, more than likely your audit will be conducted by mail. If your situation is a little more complex, your audit will be conducted in person. An in-person audit can take place at your home, place of business, at your representative's office, or at an IRS office. The auditor will ask for specific documents. If your audit is being conducted through the mail, when you mail your documents to the auditor, please make sure that you request a confirmation receipt from the post office or whatever carrier you're using. That way, you will know that the IRS received your documents and you will have proof that you sent the documents. You don't want the auditor to make negative adjustments to your tax return because they thought you didn't respond. Now, an original return or an amended return or both could be selected for audit. If you file an amended return, it does not increase your chances of being audited. There are a few ways that your return can be selected for audit. The IRS uses software and AI to select tax returns for audit. If your tax return is out of range when compared to returns that are similar to yours, your tax return will be picked out for review. An auditor will manually review your return to decide if it should be audited. Another way that your return can be selected is when it's discovered that you have transactions with another person or entity who is being audited. Also, sometimes your tax return can just be selected at random. And then there are the audit risk red flags and triggers that increase your chances of being audited. Let's take a look at 7 of those now. 1. The foreign bank accounts and assets audit risk. The IRS is always suspicious of taxpayers with foreign bank accounts and assets. These are audit red flags because the IRS knows that sometimes taxpayers use foreign accounts to hide money and income-producing assets to avoid paying federal income taxes. The IRS has requested non-U.S. banks to give reports to the IRS for American account holders who have an account over $50,000. As of 2024, though, the IRS is taking a hard look at those with foreign bank accounts and assets that are more than $10,000. So the IRS requires you to report foreign bank accounts and assets that you have that are over $10,000. The unfortunate thing about foreign accounts is you can be audited if you report it, and you can be audited if you don't report it and the IRS finds out about it anyway. The thing is, if the IRS finds out about your foreign bank accounts and assets and you didn't report it, you could end up paying a lot in penalties. 2. The You've Got Digital Assets audit risk. Owning digital assets is a fairly new audit trigger. A lot of taxpayers are not aware of the tax consequences of owning cryptocurrency such as Bitcoin. They may not know that most types of swaps, acquisitions, staking, and sales could result in taxable income. So in 2022, the IRS decided to increase the number of audits for tax returns with digital assets. The IRS has been issuing subpoenas to brokers and crypto exchanges to get information about users who own digital assets. The IRS will ask for information such as Social Security or ID numbers, names, addresses, and account activity. If you haven't been reporting your digital assets, don't be surprised if the IRS contacts you for an audit because they were able to get your information by using a subpoena. Even if you do report your digital assets, the IRS might want to take a look at your losses to make sure that the losses aren't overstated, especially since the IRS discovered that some crypto owners were creating fake losses by selling the crypto to themselves at a loss by using the different crypto wallets that they own. Please keep in mind that you have to report your digital asset transactions to the IRS, and this includes when you use digital assets to pay for goods and services or when you exchange your digital assets for cash or other digital assets. No matter what, please keep detailed records of your digital asset transactions, just like you would your stock transactions. 3. The not reporting all of your income audit risk. Not reporting all of your income is an audit trigger, mostly when it comes to 1099s and W-2s. Companies that you work with will send copies of your 1099s and W-2s to the IRS. Then, IRS software will automatically detect whether you included all of your 1099s and W-2s on your tax return and whether the amounts match. Sometimes the IRS will just add on the missing income and send you a notice letting you know that you owe more in taxes. Or the IRS can choose to do an audit. 4. The Your Deductions Look High audit risk. The IRS uses software to compare your deductions to other taxpayers in your same income range. If your deductions are high when compared to others, that's an audit trigger. Not only that, the IRS looks at your income to see if your income can even support all the deductions and credits that you are claiming. As of 2024, huge deductions and credits are high up on the IRS's watch list. 5. Did you really give that much to charity? Audit risk. Since taxpayers abuse the charitable contributions deduction so much, if this deduction is high, it's an automatic audit red flag. The IRS understands the rule of tithing, so a deduction over 10% might get questioned. The IRS knows that it's easy to put any cash amount as contributions on your tax return, as well as fake non-cash contributions. When it comes to non-cash contributions, putting one lump sum amount on your tax return is not acceptable. You have to attach a detailed schedule. If an auditor notices that you don't have a schedule attached to your tax return, that could be an easy audit adjustment for that auditor. 6. The large refunds audit risk. I know that it might feel good to get a big check back from the IRS, but that's an audit trigger. It's a bit unusual to get a large refund if you only have a W-2. What normally happens is a taxpayer will create fake deductions or a fake business to create losses to offset income. A return like this might be sent to an auditor for manual review, and if it looks fishy, the return might get audited. 7. The oops, you used the Dishonest Tax Preparer audit risk. Having a tax preparer who is on the blacklist is an audit trigger. A tax preparer can be added to the blacklist in a number of ways. An angry client can report the preparer to the IRS. Sometimes when a tax preparer is going through a divorce, they will get reported by their soon-to-be ex-spouse. But most of the time, a tax preparer ends up on the blacklist when a taxpayer gets audited and there are crazy deductions that the taxpayer cannot support. The IRS will look at who prepared the return and start a domino effect of auditing all the tax returns signed by that preparer. Tax preparers are required to use an identification number so the IRS can easily identify the returns that they have completed. The IRS may not audit the tax returns of blacklisted preparers right away though. A lot of times they will wait a few years before auditing those returns. I'll give you a real world example. One of my friends used a tax preparer that was being used by his friends because the tax preparer would get large refunds for its clients. The tax preparer would make up fake deductions in a business to get the refund. Around 3 years later, my friend and the people that he knew were all audited. They were mail audits, and the auditor simply asked that they send in their documentation to prove all of the expenses that were being claimed. My friend didn't have documentation, so now he owes the IRS thousands of dollars in taxes, penalties, and interest that he cannot repay. The sad thing is, he tried to start a legitimate business after he was audited, and the IRS automatically keeps removing all of the deductions that he claims for the legitimate business. So now he is stuck in a loop of not being trusted by the IRS, and he doesn't know how to get out of that loop. The bottom line is, if a tax preparer is selling you a "it's too good to be true" type situation, you might want to find another tax preparer. Also, if a tax preparer is not willing to sign your return, you probably shouldn't use that person. You don't want a preparer who isn't willing to stand behind the numbers on your tax return. Of course, anyone can be selected for an IRS audit, even if you don't have any red flags or triggers on your tax return. So please remember, if you're ever audited, you do have rights and you should make sure that you know them. Please watch the video in the lower left of your screen to find out more about your rights. If you have a small business and you want to know more about the red flags and triggers for a business, please watch the video in the upper left of your screen. All the best to you.